Hi, this is Jeff Iannone again. So last time we talked about a structure for financial stability. I want to talk to you a little bit about assets and income. So income is anything that you earn from salaries, self-employment income, or even current investments that you have. Dollars that come into the household that you then have a choice of whether or not to reinvest those dollars or to spend them. So I look at money as you're running your own corporation. So everybody has their own personal company, and you're trying to grow that company through income in and reallocating those dollars to investable assets. Each dollar that you put to work is like putting another employee to work for you under your corporate structure. You put a person out there, or in this case a dollar, and that dollar earns you additional income, makes you more profit, and that profit gets reinvested and it compounds over time, and that is how you actually build wealth. Assets are items that you're accumulating to help drive that wealth creation. Now, all assets are not created equal. So you may have a balance sheet or something you have to fill out for a bank, and you may put, say, an automobile on that. Okay, in theory that has value. You buy a car and it has some value, but to me that's a depreciable asset. With one thing we know about a car is it's eventually going to be worth $0, right? It's going to be either the engine's going to blow, you're going to sell it, or it's just not going to be valuable to you at that point. So any dollars that you're putting to work into that asset is going to become worthless at some point. So I don't really even look at a car as an asset because it's a depreciating item. I look at more of it as a liability versus, say, stocks or rental property. Those items you assume will appreciate over time. And those are the items that we want to focus on when we're taking our investable dollars and putting them to work. So if you understand those two concepts, then we can kind of move into each of the topics that we want to discuss. So investing, let's look at that for a minute. Again, that was our first item on our structure for financial stability because we're paying ourselves first. Well, when we're investing our dollars, we want to be diversified, okay? But it's important as to what type of accounts you have. So the most important thing you can do is save for retirement. Now, some of you may be very young and may be thinking retirement's years off, but the reality of it is, and the reason I say that is, you can't borrow to live during retirement. The assets you accumulate over your lifetime are going to be the assets that you have to be utilized during that time frame. College education, if you need to, you can borrow and you can send your children to school that way, or they can get their own loans. But when it comes to retirement, you have to have those assets. That doesn't mean we want to have all of our assets, though, locked up in retirement type of accounts. So you have IRAs, Roth IRAs, 401k plans, those type of things. There's a lot of benefit to those. They grow tax deferred and in some cases tax free. However, there are limitations. You can't receive that money or utilize that money until you're at least 59 and a half. So you have to have some what I call long-term non-retirement assets, meaning perhaps they're not tax deferred or tax free, but they have more liquidity and flexibility for you. So those are the assets that you're foregoing some of the tax benefit in order to have more flexibility in regard to your middle-aged life, 40s, 50s, if you want to retire early, if you want to use some of that money to buy a second home or rental properties, that's the assets that you're able to use. So we'll go back to that in the future, but that is the type of asset we want to try to accumulate. Now, taxes is something I mentioned we really can't do anything about. We estimated 30%. Well, you can, to some degree, practice tax avoidance. I'm not talking about tax evasion, that would be illegal. You want to report all of your income. However, tax avoidance is what anybody does when they itemize their deductions, for instance. So oftentimes you hear in the news that high income or wealthy people do not pay as high a tax rate as somebody that maybe earns less than them. That's because having assets allows you to utilize them in the best way possible. So for instance, let's say somebody has accumulated a large amount of non-retirement assets, investments, stocks and bonds, and they decide they need a down payment for a house. Well, likely is they're not going to sell those assets to generate a capital gains and have to pay tax on that. They're going to borrow against those assets, which avoids taxation, but allows them to make the same purchase they would make otherwise. Versus someone who hasn't accumulated those type of assets, their situation is going to be different. They have no choice. They either have to pay the tax on the income that they're receiving, or they're going to have to generate a capital gain in order to take whatever money they do have and redirect it. So that's just one example, but it's one of the things that accumulating wealth will show you that over time, whether it be through a corporation or utilizing other assets in different capacities, you're able to reduce your annual tax liability without having to lose your investable assets. Now, housing is an item that you've often heard probably where people say, well, that's most people's largest asset, or it will be somebody's largest asset. If you're doing that or you're thinking that way, you're completely backwards. It should not be your largest asset. And why do I say that? So again, as I mentioned earlier, assets, there's all types of assets. There's depreciable assets, appreciating assets, and a house would fall into the appreciating category. You would hope that over time you would earn a higher value on that property. However, you have limitations with your house. You can't utilize the equity in that house to live off of unless you borrow from the bank, and oftentimes through a home equity line or a mortgage, rates can be high, or you have to sell that house. No one wants to be in a situation where they have to do one of those two things to be able to live in retirement, for instance. So though it's an asset that's more valuable than, say, a car, I would argue, and that's why I put it in the third category of our financial stability model, is I would argue that it's not as valuable as stocks, bonds, and even a rental property that you might own that's going to generate cash flow to you in the future. Finally, again, discretionary spending that we talked about. So this category is broad, and this is the area that most people, when they're looking at wanting to spend, they, again, either overspend or they undersave. Well, taxes often directly influence this area. If you're paying, say, 30 to 35% in taxes versus paying, say, 25% in taxes, most of that money would flow through to this category. So oftentimes people want to pay lower taxes so they have the discretionary spending to put to their own use. Otherwise, you get stuck in a situation where you have to make sure you budget for the right type of car. Certain things are going to be fixed. You're going to have utility expenses and food and things like that. But you want to structure yourself so that your car payment comes out of here and you're not cutting into the growth of the investable assets. So one last thing is with this discretionary spending is sort of like what I call opportunity cost, okay? And that is, let's say you want to buy a car and you decide you want to spend cash for that instead of having it be one of your discretionary items. And if that car is going to cost you $20,000, then the question is, what are you really paying for that car? If you're 25 years old and you were to earn, say, 7% per year on your investments, taking $20,000 out of investable assets or an appreciating asset into a depreciating asset, which is, again, where you know is going to be worth zero someday, is not going to cost you $20,000. It's going to cost you $20,000 plus the future growth on that. So in this case, you're 25 years old, you take $20,000 out of your investments. What you're really spending is the $20,000 plus the potential growth on that. At 7%, that money would double about every 10 years. So at age 35, your money grows from $20,000 to $40,000. And at 45, you're now at $80,000, or would be if you didn't spend that $20,000. At 55, you've now got $160,000. And at 65, you would have $320,000. So you can see where buying that car with an appreciating item is not actually spending $20,000 of your investments. You're actually spending the potential growth as well, which in this case, that $20,000 could become worth up to $320,000 with the 7% annualized return. I hope you found this interesting. We'll continue our series going forward, but in the meantime, please follow us on social media and subscribe to our YouTube channel.